This LOS is explain the specification of asset classes in relation to asset allocation. Portfolio construction, the strategic asset allocation. The strategic asset allocation is the set of exposures to investment policy statement permissible asset classes that is expected to achieve the client's long-term objectives given the client's investment constraints. It's based on risk, returns, and correlations of asset classes. Correlation of returns of assets within an asset class should be relatively high. Correlations of returns between asset classes should be low. Traditionally, investors have distinguished cash, equities, bonds, and real estate as the major asset classes, or sometimes we call it traditional asset classes. In recent years, this list has been expanded with private equity, hedge funds, and commodities. In addition, such assets as art and intellectual property rights may be considered asset classes for those investors prepared to take a more innovative approach and to accept some illiquidity. Combining such new asset classes as well as hedge funds and private equity under the header alternative investments has become accepted practice. The strategic asset allocation. On the left-hand side, we have our long-term capital market expectations, which is made up of expected returns of different asset classes, the variances, which is risk, and covariances and correlations. On the right-hand side, we have the investment policy statement with the investor's objectives and constraint. Remember, those are the risk and return objectives, and the constraints was LLTTU, legal, liquidity, tax, time, and unique circumstances. And those meet. Now this next box is kind of a new one. It wasn't always there. Usually the long-term capital expectations mixed with the investment policy statement would feed right into the strategic asset allocation. But now there's a step before that where sometimes there's an optimization or some type of simulation modeling. Out of that comes the strategic asset allocation. An example could be a balanced portfolio or a portfolio for income, or something less risky to more risky. And that's, in theory, that's the optimal portfolio from the efficient frontier. And that's the last slide for this LOS. Thank you very much.